What are the top 3 red flags you need to watch out for when you're analyzing buying an accounting firm and focusing on how much cash flow does this firm actually make? Let's jump in, do the swipe thing. Let's go. And as a thank you for subscribing, commenting, and liking this video, here's a picture of a really cute little otter working hard in January, getting all those 1099s done for clients. Don't you just love that part? Okay, so before I tell you those 3 red flags, I think it's important enough for you to know a couple of things, just a couple of clarifying points. Number 1, what the heck is true SDE or cash flow? SDE stands for seller's discretionary earnings. This is the cash flow of the firm, the profit of the firm on the P&L, or as those fancy CPAs call it, income statements.
Oh, that's a good one there.
The purpose of what they call add backs is exactly that. You're trying to take the profit of the firm and you're trying to add back expenses that you as the new owner will not incur once you own this firm. Maybe they're paying for $1,000 a month truck and you have your own vehicle, so you don't have to expense that out every month. You can add that back to the bottom line. Now, the problem with add backs is that owners, and let's be honest, it's probably more the brokers, but owners and brokers are going to be extremely aggressive with the add backs that they want to include to really maximize the cash flow. So let's say you got a firm, it's making $1 million on the top. On the bottom, after they run everything through, they're making $100,000 in profit, but then they want to add back, their truck and their phone and all these other things. And now it looks like, oh, well, this firm is making $400,000 a year after the add backs. Some add backs are good and standard and normal and totally logical, and some of them are completely bogus. And guys, it's not just about whether we think the add back is valid or not. If you're getting financing, let's say the SBA, you are going to run into the underwriters questioning certain things that they're putting on their add back that may not be valid either. So we want to know up front and try our best to do the due diligence up front to make sure that only true valid add backs are being added to the bottom line, and they don't have this laundry list of add backs to make their $100,000 in profit firm look like a $400,000 in profit firm.
Hey, you can't blame me for trying. I'm just trying to retire.
By the way, guys, if you are interested in talking a little bit more, maybe you're looking at a deal right now, or maybe you're ready to be looking at deals, you just have no clue what you should be looking at, there's a link in the description below. Feel free to book a call with me. We will jump on and we'll talk about your individual situation, what you should be looking for, what you should watch out for, those types of things. Feel free to book a call. We'll talk about it. But I got to warn you now, I'm a very no fluff kind of guy. So I'm going to give you the good, the bad, and the ugly of all things buying an accounting firm. So if you're ready for that, book a call. We'll talk. So what are these standard valid add backs that we always see? And let me remind you one more time. The purpose of the add back is that we take the net profit of the firm and we add back expenses that you as the new owner will not incur in the normal course of business. So we can't add back your QuickBooks subscription because that is part of your normal expenses to run the business. But we can add back that $1,000 a month truck payment that the owner's running through. The most common one is going to be the owner's salary. So if they are paying themselves a $100,000 a year salary and we're starting off with $100,000 on the bottom line, I'm completely fine. The bank is completely fine with you adding that back because they will no longer be getting paid that salary. Right alongside their salary is also their portion of payroll taxes. Completely valid. You will save on those payroll taxes. The next thing aside from salary and the payroll taxes is going to be like health insurance. Maybe they have life insurance running through there, a retirement account for themselves. All of that stuff that can validly, easily be added back. The bank will have no problem with those. Those are owner benefits. A few other ones that are going to get added back very easily is if they have amortization, depreciation, and interest. The idea is none of those will be running through once you're the new owner. Now, once you own it, if you have things you're going to be amortizing or incurring interest on or depreciating, that's on you, right? But up front, you can add those back and add it to the bottom line. The first thing you need to watch out for are non-recurring items. So let's say you're looking at a firm and they had some special engagement with a client and it was for $75,000 in revenue, just some massive big project of theirs. Well, that was a one-time thing. And if you're looking at last year's P&L and you see 75 grand, that's 75 grand in revenue, which obviously had margin in it, which flowed to the bottom line. So now we got to look at it as we got to reduce that revenue by 75K. We also got to reduce the cash flow by whatever that margin is so that we can have a good starting point. We are not going to be counting. We can't count on monies that will not be there once we buy the firm. So it's very important that we understand and distinguish what are the recurring, normal, expected types of services versus this was a one-time, non-recurring transaction that will not happen in the future. Very, very important. Make sure you catch this because these brokers, guys, I want to be clear. These brokers don't care about you. They are on the side of the seller. They are working in the best interest of the seller.
Hey, I didn't know nothing about it. It was the broker.
You need somebody in your corner who's going to make sure you're protected. And by the way, that's where myself and my community come into play. We have people that are CPAs, EAs, accountants that are acquiring firms, getting deals across the finish line left and right. And so if you're interested in learning a little bit more about that community, there's a link in the description below. But you got to make sure you got somebody in your corner. Those brokers will rake you over the coals. I had one that was trying to get one of our members to pay a 10% $80,000 earnest money deposit on an $800,000 firm that they got done. And I'm like, wait a minute, this is ridiculous. Long story short, we got them to accept a $5,000 earnest money deposit. That is a prime example of them being like trying to bully you. Unfortunately, I think that this, like, we're bordering on the line of ethical and unethical at this point. But if you don't know any better and you don't have anybody in your corner, you're going to think it's standard. You're going to pay all that. You're going to do whatever they say. Get somebody in your corner. Doesn't have to be me. Doesn't have to be my community. But get somebody in your corner as you're moving forward and acquiring an accounting firm. The second red flag are forms of payment that the owner is getting from the company, but they didn't run it through the P&L. What does that even mean? I'll give you the perfect example. We have a member that was working on a deal and the owner had a $93,000 add back to the bottom line, trying to maximize what their cash flow was in the company. When we asked them about this add back, the owner, as you can see, said, oh, that was a distribution from the S Corp straight to me that didn't run through the P&L. Red flag, hello.
Hey, if you don't catch it, it ain't my fault.
If it doesn't run through the P&L, I can't add it back. And this is a prime example of making sure that you are navigating these deals correctly. This goes to something I always say, no double dipping. No double dipping. And that one hurt. It was a big impact to the bottom line. Now, our member was still able to push forward with it and still able to get that deal signed, but at least they're walking into it with a more true picture of what that expected cash flow can be. The third red flag to watch out for is going to be in the example of when the firm owner owns the real estate. And I've seen this. This is a very common one you need to watch out for. When that owner owns the real estate, there is a chance that they are not charging themselves rent. And look, I don't think this is a right or wrong. I think it's a preference thing. But for the purposes of cash flow, if they own the building, we're not going to be buying the building. We're just going to be leasing at that point. but in their P&L, there is no rent expense in there. We are going to have a rent expense. So if they don't have it running through the P&L, we need to add what we believe, and this will take a little bit of digging and research, but you got to add a market rate rent, or at least ask them, what are you going to charge me for rent, so I can plug it in the P&L so I can get a true picture of what that cash flow is actually going to look like. In addition to that, they might have a rent running through the P&L, but it might be severely under market. Like they kind of just did it just to do it. Well, we know that when we buy it, they're more than likely going to put us up at market rate. So that difference has to be accounted for. This is so vital that you get this, guys. You have to make sure that the cash flow of this firm is a realistic picture of what you're going to be expecting. Conservatism, conservatism, conservatism all throughout the process. Or as those fancy CPAs say, professional skepticism. By the way, if you're interested in learning 5 different ways to acquire an accounting firm for no money out of your own pocket, comment 5 down below and I'll shoot over that information. It's a 90-minute call, and I'll be honest, I'm willing to bet it's more than you care to even watch, but it is going over all those different strategies in depth and exactly how you can execute those and frame them up so you don't come a dime out of pocket. All right, guys, I hope that helps you out. Make sure you stay on your toes and keep your eyes wide open when you're analyzing these deals. And remember, it's a cruel world, but we're better together. We'll see you later.